The game has changed, and the stakes couldn't be higher. Jerome Powell made a decision that sent shockwaves through the financial world. For the first time in 4 years, the Federal Reserve cut interest rates. Powell's decision to cut interest rates isn't just another headline. It's a seismic shift that could redefine the financial future of every American. But what does this mean for you, your wallet, and the future of the American economy? Is this the beginning of a new era of prosperity, or are we standing on the precipice of a recession? Join us as we unravel the implications behind Jerome Powell's September rate cuts and ask the burning question: is this a sign of an impending U.S. recession? But before we dive into the implications of this momentous decision, let's rewind and explore how we got here. Cast your mind back to early 2020. The world was in the grip of the COVID-19 pandemic, and economies everywhere were grinding to a halt. In a dramatic move to stave off economic collapse, the Federal Reserve slashed interest rates to near zero and launched an unprecedented program of quantitative easing. For a while, it seemed like this extraordinary intervention had saved the day. The stock market rebounded, unemployment fell, and the economy began to recover. But as we all know, every action has consequences. And in this case, those consequences came in the form of soaring inflation. As the economy roared back to life in 2021 and 2022, prices started to climb at a pace not seen in decades. Suddenly, the Fed found itself facing a new challenge: how to tame inflation without tipping the economy back into recession. And so began a series of aggressive interest rate hikes, pushing the federal funds rate to levels not seen in over 20 years. Now, fast forward to today. Inflation has cooled significantly, but the specter of recession looms large. And that brings us to Powell's pivotal decision. In a move that's already being hailed as historic, the Fed has cut rates by 50 basis points, signaling a new chapter in our economic story. But what does this mean for you? How will this decision impact your savings, your investments, your mortgage? And more importantly, is this the beginning of the end for the U.S. economy as we know it? Stay tuned, because we're about to unpack all of this and more in the next segment of our journey. This rate cut is a clear sign that the Fed is concerned about the economy's trajectory. They're trying to engineer a soft landing, but it's like threading a needle while riding a roller coaster. Historically, when the Fed starts cutting rates, it's often a precursor to economic trouble. The question now is, can Powell pull off what no Fed chair has done before? Cut rates without triggering a recession? To understand what might lie ahead, we need to look at how rate cuts have impacted the economy in the past. Since 1990, there have been several instances of Fed rate cuts. In some cases, like 1995 and 1998, these cuts helped prolong economic expansions. But in others, such as 2001 and 2007, they preceded recessions. The key difference? The size of the initial cut and the overall state of the economy. While historically, cuts of 50 basis points or more have often signaled imminent recession, in our current unique economic climate, a more aggressive 50 basis point cut might be exactly what's needed to avoid a downturn. By opting for a bolder 50 basis point cut, Powell and the FOMC could provide a stronger boost to the economy, potentially achieving a soft landing more quickly and decisively. But the burning question remains: is a soft landing still possible, or are we inevitably headed for a recession? In the wake of the Fed's rate cut, the economic picture remains murky. Like a captain navigating through fog, Jerome Powell must rely on imperfect information to chart the course ahead. For the average American, the impact of this rate cut will unfold gradually over the coming months. Let's break down what you might expect to see in the next months. First, borrowing costs should begin to decrease. This means lower interest rates on everything from mortgages to auto loans to credit cards. For homebuyers, this could make purchasing a house more affordable. For existing homeowners, it might present an opportunity to refinance. However, it's important to note that these changes won't happen overnight. Banks and lenders often take time to adjust their rates, and some may be hesitant to lower them significantly if they believe more cuts are coming. Consumers shouldn't expect to see dramatic drops in their borrowing costs immediately. It's more of a gradual process, and the full effects might not be felt for several months. On the flip side, savers may see the interest rates on their savings accounts and certificates of deposit start to decline. This could push more people towards riskier investments in search of higher returns. Speaking of investments, the stock market often rallies in the immediate aftermath of rate cuts. However, this initial enthusiasm can be short-lived if economic data continues to deteriorate. Investors need to be cautious. While rate cuts can provide a temporary boost to stocks, they're often a double-edged sword. If they're happening because the economy is weakening, that's ultimately not good for corporate profits or stock prices. What about businesses? Lower interest rates can make it cheaper to borrow and invest. This could lead to increased spending on capital goods, research and development, and potentially hiring. But here's where things get tricky. If businesses believe a recession is coming, they might hold off on major investments or even start laying off workers, regardless of lower borrowing costs. It's a bit of a psychological game. The Fed is trying to boost confidence and encourage spending and investment. But if people and businesses don't believe in the soft landing scenario, their actions could become a self-fulfilling prophecy, leading to the very recession the Fed is trying to avoid. This brings us to the million-dollar question: soft landing or recession? The case for a soft landing rests on several factors. Inflation has been trending downward, albeit slowly. The labor market, while showing signs of weakness, remains relatively strong by historical standards. And consumer spending, the backbone of the U.S. economy, has proven resilient. On the other hand, warning signs are flashing. The yield curve, a historically reliable predictor of recessions, has been inverted for months. Manufacturing activity has been contracting, and the lagged effects of the Fed's previous rate hikes are still working their way through the economy. The truth is, we're in uncharted territory. The pandemic and the policy response to it have created distortions in the economy that make historical comparisons difficult. Powell is attempting something that's never been done before, raising rates aggressively to combat inflation and then cutting them just enough to avoid a recession. As we move forward, all eyes will be on key economic indicators. The unemployment rate, GDP growth, and inflation will be scrutinized for any signs of trouble or relief. For Jerome Powell and the Federal Reserve, the coming months will be a high-stakes balancing act. Too much easing could reignite inflation, while not enough could tip the economy into recession. And for you, the American consumer and investor, the message is clear. Stay informed, be prepared for volatility, and remember that economic shifts, whether positive or negative, rarely happen overnight. As we conclude our journey through the complex world of monetary policy, it's clear that the actions of Jerome Powell and the Federal Reserve will have far-reaching consequences for every American. Whether we achieve the elusive soft landing or face the challenges of a recession, there are lessons to be learned and actions you can take to protect your financial future. Want to be prepared for whatever the economy throws at you? The secret is to be flexible and think ahead. Don't just hope for the best or expect the worst. No oracle can tell you exactly what the economic direction will be. So, the wisest advice is to get ready for both scenarios. So, here are some actionable advice. First, build a safety net. Save up enough money to cover your expenses for 3 to 6 months. That way, if you lose your job or have unexpected costs, you won't be in trouble. Next, take a look at your debts. If interest rates are going down, it might be a good time to refinance your loans. This means getting a new loan with a lower interest rate. When it comes to investing, don't put all your eggs in one basket. Spread your money around different kinds of investments, like stocks, bonds, and real estate. That way, if one thing goes wrong, you won't lose everything. Stay informed, but don't panic. Keep an eye on the news about the economy and the Federal Reserve. But don't make rash decisions based on what happens in the short term. Finally, invest in yourself. Learn new skills or get a degree. This will make you more valuable in the job market and help you succeed no matter what the economy is doing. Remember, economic cycles are a natural part of our financial system. While we can't control the actions of the Federal Reserve or the overall direction of the economy, we can take steps to build our own financial resilience. Ultimately, Jerome Powell's legacy will be determined by what happens in the coming months and years. But regardless of the outcome, this period will be studied by economists and policymakers for generations to come. As we look to the future, one thing is certain: the decisions made today will shape the economic landscape for years to come. Stay curious, stay informed, and remember that in the world of finance, knowledge truly is power. And there you have it, folks. The breakdown of Jerome Powell's September rate cuts and what they could mean for the U.S. economy. We've taken you on a journey from the depths of the pandemic to the crossroads we face today. But now, we want to hear from you. What do you think? Are we headed for a soft landing or a recession? Leave your thoughts in the comments below. But hey, why not share this video with a friend or family member who might benefit from this information? Knowledge is power, especially when it comes to finance, and sharing is caring. And if you found this video helpful in understanding the complex world of monetary policy, please give it a thumbs up and consider subscribing to our channel for more in-depth economic analysis. Remember, the more we understand about the forces shaping our economy, the better equipped we are to navigate our own financial futures. Before we go, I want to leave you with one final thought. Yes, the economic landscape might be uncertain. Yes, there may be challenges ahead. But remember, every crisis also brings opportunity. Stay informed, stay prepared, and most importantly, stay curious. The world of finance is always evolving, and there's always more to learn. Until next time, this is reminding you that in the world of finance, knowledge is your most valuable asset. Take care and invest wisely.